Your debit card looks harmless, but it can quietly wreck your month. A thief taps it once, and your real cash vanishes from checking while the bank investigates. One switch most people ignore, using a pay-in-full credit card for daily spending, shields your money and builds your FICO score at the same time. And here's the kicker in the actual rules. Credit card fraud liability is capped at $50 and often $0 by network policy. With debit, it can be $500 if you report late and unlimited after 60 days. That gap isn't theory, it's design. Credit cards sit between you and your bank account, so disputes and fraud don't yank your rent money while things get sorted. Debit pulls from cash instantly, and investigations can take days. If you want a simple, repeatable way to be safer and richer, adopt the pay-in-full framework starting today. One primary credit card for purchases, auto-pay the statement balance every month, and keep debit for cash and emergencies only. Why does this work so well? Because U.S. credit cards come with strong protections and a grace period when you pay in full. That means everyday purchases can float interest-free until the due date. Debit gives you none of that. No float, fewer dispute rights, and the risk of overdraft or holds that lock up your money. The rookie mistake is thinking, debit is safer because it's my cash, when the opposite is often true for daily swipes. Let's put numbers on it. Under federal law, your credit card fraud liability is capped at $50, and the major networks generally promise zero liability if you report promptly. For debit, notify your bank within 2 business days, and your liability is limited to $50. Wait longer, and it can jump to $500. And after 60 days from the statement, you can be responsible for losses that happen after that point. Even if you're reimbursed, your cash can be tied up during the investigation, which can collide with rent, bills, and payroll. Now layer on credit scoring. FICO, the most used score, rewards on-time payments and low balances. Payment history is the biggest chunk of FICO, and amounts owed, your balances versus your limits, is the next big piece. Using a credit card for daily spending and paying in full feeds your score with positive signals, months of on-time payments and low utilization. Debit swipes don't help your score at all. Your payoff can be 4 figures. A stronger FICO score can lower rates on car loans, mortgages, and personal loans. On a modest auto loan, shaving 1 point off your APR can save hundreds over the life of the loan. On a mortgage, better credit can be worth many thousands. The same groceries and gas, paid the smart way, can translate into real money when you borrow. Here's the simple framework to copy tonight. 1. Pick a no annual fee credit card you can live with long term. 2. Set auto pay to the statement balance so interest never starts. 3. Route every everyday purchase you used to put on debit, groceries, gas, subscriptions, to that card. 4. Make a mid-cycle payment if your balance creeps too high so your reported utilization stays low. 5. Keep your debit card for ATMs, cash, and true emergencies. The grace period is your friend. Most cards don't charge interest on purchases if you pay the full statement balance by the due date. That's like a short, interest-free loan every month. If you only pay part, you lose the grace period and interest kicks in on new purchases, so the whole framework depends on paying in full. That's why we lock in auto pay for the full statement amount, not the minimum. Let me show a before and after. Before, you buy groceries with debit and someone schemes your number at a gas pump. Your bank account is drained by $600 and your landlord still wants the rent while the bank investigates. After the switch, the same fraud hits your credit card, you dispute. Your cash never leaves checking, and the issuer temporarily credits the charge while they investigate. Same fraud, different outcome. Your cash stays put. There's another hidden leak. Holds. Gas pumps, hotels, and rental car counters often place a hold to make sure you can pay. On a debit card, that hold freezes your cash for a day or more. On a credit card, it just parks against your limit and your checking balance stays available. If you've ever wondered why your account balance looked fine but your available was tiny, a hole was probably the culprit. Here's a second big protection that credit offers. If a merchant won't deliver or ships junk, credit card rules give you a built-in path to dispute, and in some cases, to assert claims against the issuer if the seller won't make it right after you try in good faith. That's leverage. With debit, you have error resolution rights for unauthorized transfers, but you don't get the same purchase protection muscle and your cash is already gone. Won't this tempt me to overspend? That's a fair pushback. Credit cards can be dangerous if you treat credit like income. The fix is to pair the card with a spending plan and to erect guardrails. Turn on transaction alerts so every charge pings your phone. Enable category or merchant locks if your issuer offers them. Add a weekly reminder to check your balance and send a small mid-cycle payment if it's drifting up. Let's make the math painless. Credit utilization is your statement balance divided by your credit limit, and lower is better. Under 30% is healthy. Under 10% is elite. If your limit is $1,000, keeping your statement balance around $100 to $300 helps your score. That's why mid-cycle payments are an easy win. If you spent $400 by mid-month on a $1,000 limit, send $250 now and let the statement close near $150. What about rewards? They're a bonus, not the point. If a no annual fee card pays 1.5% to 2% back and you always pay in full, that's free money on top of safety and credit building. But 1 month of interest wipes out months of rewards, so never chase points if it risks carrying a balance. Keep it boring and automatic. Build a small emergency fund alongside this. A starter goal is 1 month of expenses parked in a safe, FDIC, or NCUA insured account. That cushion means a weird bill or delay in a refund doesn't send you scrambling. If you're starting from zero, use the 50/30/20 rule as training wheels. 50% needs, 30% wants, 20% savings and debt payoff. Funnel that 20% toward your starter fund and any high interest balances first. Speaking of balances, here's the bright line rule. If you carry credit card debt, your first job is to stop the bleeding. Switch to using debit or cash for day-to-day while you attack the balances with the avalanche method, highest APR first, or the snowball method, smallest balance first, if you need quick wins. When the slate is clean, adopt the pay in full framework and keep it clean for good. Let's talk mistakes to avoid. Don't pay late, even by a day. A single late mark can hurt your score and may trigger penalty rates. Don't max out your limit. High utilization can ding your score and raises risk. Don't take cash advances. They usually have no grace period and higher fees and rates. Don't fall for deferred interest promos that backcharge interest today, one if you miss the window. Here's a 5-minute setup to make this real. Step 1. Pick a simple card. No annual fee. Broad acceptance. Clean mobile app. Step 2. Turn on auto pay for the statement balance and set a reminder 2 days before the due date to verify funds are ready. Step 3. Move your recurring charges, phone, streaming, utilities, onto the card so you stack on-time payments. Step 4. Freeze your debit card in the app when you're not using it. Step 5. Add 2 recurring calendar blocks. Every Friday, eyeball spending, and if needed, send a $25 to $100 mid-cycle payment. On statement close day, check your utilization and skim any surprise charges. Step 6. Enable instant transaction alerts and location-based security, so a purchase in another state pings you immediately. Step 7. Keep your card info off sketchy sites. Use virtual card numbers when your issuer offers them for online purchases. What if you're new to credit or rebuilding? Start with a secured credit card from a bank or credit union, put down a refundable deposit, and use the same pay in full framework. Add a second card after 6 to 12 months to build more available credit and diversify issuers. Keep old accounts open unless they cost you money. Length of history matters, and time in the system is your friend. Fraud happens to careful people, too, so plan your response. If you see a weird charge on your credit card, lock the card in the app, call the number on the back, and file a dispute. Because it's credit, a temporary credit often appears while the issuer investigates. If it's debit, speed matters. Report fast to keep your liability low and ask your bank about provisional credits during the review. There's a psychological win here. Running purchases through a card and paying in full separates, buying from paying. You get a weekly review of the tab and a monthly due date, which is a clean moment to trim waste. With debit, the pain is invisible until the balance is low, and by then it's often too late to dispute a busted product or a shady recurring charge that slipped in. Quick micro story. Jamie earns an entry-level salary and uses a debit card for everything. Skimmer hits her number and $900 in fraudulent charges clear in 3 days. Her bank starts an investigation, but payday is next week and rent is due. After switching to pay in full credit, the next fraud is disputed, removed from the statement, and her cash flow stays intact. This is how you help your FICO score grow up. Every month you pay on time, your payment history lengthens. Every month you keep balances low on statement day, your utilization looks healthy. Over time, those 2 levers do the heavy lifting, and you don't need hacks or fancy cards, just boring, automatic on-time paid in full cycles. Remember the villain. It's not the plastic. It's the interest and fees that hit when you carry a balance or bounce a payment. APRs on revolving balances are steep. The system beats the APR because it never lets interest start, and it keeps your cash safe from debit fraud delays and pre-authorization holds that can blow up your month. Here's a clean decision tree. If you have revolving debt, pause card spending and hammer balances first, then return to pay in full. If you're debt-free but anxious about overspending, set a low self-limit and weekly check-ins. If you're debt-free and comfortable, move daily spending to the card, set auto pay to full, add mid-cycle payments, and watch your score climb. Store cards and 0% deals deserve caution. Store cards often start with tiny limits and high penalty rates, which makes it easy to spike utilization and hard to fix it. No interest if paid in full, can backcharge interest from day one if you miss the window. Keep your system simple. 1 or 2 general-purpose cards you can keep for years. If you want fast, safe score gains, focus on timing. Statement day is the snapshot most issuers send to the bureaus. Aim to have a small balance, 1% to 10% of your limit, reporting on one card and 0 on the others. That shows you use credit but don't need it. Then autopay wipes the slate clean, every due date. When does debit still make sense? Cash withdrawals, small local vendors that charge card fees, or if you truly must force a hard cap on spending while you reset habits. If you use debit, turn on low balance alerts, opt out of overdraft where possible, and keep a small buffer. But for everyday purchases, the pay in full credit card framework is the safer, richer path for most beginners. Here's the punchline. Use a credit card like a debit card with better armor. Spend only money you actually have, pay the statement balance in full, and keep utilization low. You get an interest-free window, stronger dispute rights, and valuable score growth. And your real cash stays safe behind the card while you live your life. You were promised a simple switch backed by receipts, and this is it. Federal rules cap credit card fraud liability and give you a clear dispute path. Debit pulls cash and raises your liability if you wait. FICO rewards on time and low balances, so your daily routine can lower borrowing costs. Small systems beat big decisions. Set auto pay tonight, move your spending to one pay in full card, and let compounding do the heavy lifting.